So we have another big week of economic data with CPI coming on the 11th, followed by a 10-year auction at 1 p.m. PPI comes on Thursday. So for the core CPI, we're looking for a month-over-month increase of 0.3%. Year-over-year, going to 2.9% from 2.8. Headline CPI expected to rise by 0.2. Year-over-year is expected to rise by 2.5%. So at least based off of what I'm seeing, this is probably going to be the last, tame CPI report, because we're expecting inflation to really start ramping back up now and probably moving back above 3% by the time we get to about September. But before we get into that, I just thought we would take a look and see what CPI swaps are pricing in, at least for this month's report. And when we look at the month-over-month data point, CPI is expected to rise by 0.3% on a month-over-month basis on headline, and it's pricing in a 2.4% increase on the year-over-year. So that would come in mix versus what the analysts have, because they have a lower month-over-month but a higher year-over-year number. I don't really think it matters much, because really what we're talking about here and looking at is a trend of inflation going higher. At least when we look at, the changes in the inflation expectations since Liberation Day, what you see here is that inflation expectations had initially jumped to around 3.7% on the day following Liberation Day. So on the 3rd of April, we were expecting inflation to peak somewhere around 3.7%. And then by the time we got to May, we were looking at it coming down to about 3.6% by the time we got out to September. And then by the time we got to June, we're now looking for it about 3.3% by the time we get to September. So, and as of right now, we're looking at it getting to around 3.2% by the time we get to September. So ultimately, the market has dampened its expectations of how high inflation is going to go over the next several months. But the idea here is that inflation is going to be significantly higher than where it is today, at least 1 percentage point higher than where it is today. And of course, depending upon how things sort of evolve, inflation could be much higher than even that. One of the reasons why I say it could be higher than that is, first of all, when you look at inflation, we've kind of been moving up at this rate of change at around 3% really since June of 2022. Here's your trend line, and we've really just been going back and forth above and below that trend line. And so you're coming into a part of the year, June, July, August, September, where you can see base effects may be unfavorable for inflation, just because we had a sharp move up into April of 24, and then things really settled down as you went from April until you went into July. So there's a chance here that base effects could play a major role in kind of pushing inflation higher, at least optically, as we move into the summer and fall months. On top of that, we know we're going to be getting the effects of tariffs, but more generally, we've been seeing inflation running at this trend of about 3%, really going back from June of 22. Also, we've been seeing lots of evidence to suggest that inflation is going to be running hotter, just because we've seen it in the prices paid indexes. Now, just because it's running hotter in the prices paid index doesn't necessarily mean we're going to see inflation go to 6%. But it is the reason why you're seeing inflation expectations running hotter as we move into the fall and into next year, because prices paid indexes tend to lead the actual CPI report by a good 6 to 9 months or so. And you can see that the ISM manufacturing prices paid peaked in June of 21, and inflation ended up peaking much later than that, July of 22. I guess if you were to compare this peak to this peak, that kind of came in line. But again, you can clearly see that manufacturing prices paid bottomed out in November of 22, and we didn't really get that first bottom until you got to around June of 23. So what this is kind of implying to me is that there's a good chance here that we're really just at the very beginning of what could be a sharper uptick in inflation in the next couple of months. And so that's going to leave the Fed in an awkward spot. The way we can think about this is that the market's projecting the Fed funds rate to come down, and at the same time, the market is also expecting the inflation rate to move higher. And so when we kind of think about what this means overall, the real Fed funds rate right now has actually come down to about 1.3% and then back up to 2%. As we've seen the CPI rate come down and the Fed funds rate basically come down at a little bit of a slower rate, that's caused the real Fed funds rate tighten a little bit because inflation right now has been falling faster than the Fed has been cutting. So a net is that you basically get a tighter monetary policy. But the problem is that the Fed is not going to be able to really cut very much, if at all, because if inflation starts moving back up again, as the market is sort of anticipating, and if the Fed funds rate starts to come down too soon, that could lead to too much easing in monetary policy, more than what the Fed desires. And so if we were to get to a point where inflation's running at 3.2%, and you got to a point where the Fed funds rate was at the market's predicted 3.6%, you'd only have a real neutral rate of about 0.4%. And that actually may result in easy monetary policy. And so it's more likely than not that the Fed is probably going to have to hold rates through a period of time until it's confident that the 3.2% number, if it should materialize, is actually, number one, achievable. Is the market's based expectations too high? Are the market-based expectations too low? Are we seeing signs now that inflation is going to start coming down based on prices paid indexes? Because if those things aren't evident yet, and the Fed starts to cut too soon, it could ease policy too quickly in real terms. The real Fed funds rate being basically Fed funds minus CPI. And so that would bring it back down to about where it was, let's say in February of 25 or so, maybe a little bit lower. And the key here is that the Fed has already indicated that the neutral rate is around 1%, and we can take this from the SEP. If you look at their longer run target of PCE, which is 2%, and then you compare that to the median long run Fed funds rate of 3%, that gives you a neutral rate of 1%. And so basically anything below 1%, the Fed would be viewing as accommodative, and anything that's above 1% would be viewed as being tight. And so basically, if you were to see Fed funds stay at 4.3% and inflation run to 3.2, it could make an argument that at 1.1%, policy is still mildly restrictive, at worst, and at best is policies at neutral. And so that would really cause the Fed to probably want to hold rates where they are for some time, until again we started really seeing some further evidence that inflation is either going to peak somewhere and then start coming down, or if there's evidence that maybe inflation is running hot, then the Fed would be forced to keep policy higher for longer, and potentially, depending on how hot, maybe be forced to raise rates again. But at this point, we're nowhere near that. We're just sort of looking out over the next 6 to 9 months, and based off of those expectations by the market, you can make, the argument would be is that the Fed probably holds rates still and where they are until probably the end of the year, based on today's data. And that's going to be, and that's going to be a point of contention, I guess, for the administration, for the Fed, maybe for markets. It certainly argues for higher long end rates. But in the meantime, we're just going to have to wait and see how all this kind of evolves. But, if this week's number comes in light or if it comes in hot, it really doesn't matter, because it's just going to, it's basically, the market expectations are that inflation is going higher from here. And it's probably not going to peak until we get sometime into September or October, just because we have some base effects going on. And then we're going to really start finding out where it's going to head from there. Anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon. Bye.